You know that feeling when you finally make a decision, when you stop hesitating, stop overthinking, and you commit to buying something because you genuinely believe it's the right move, and then almost immediately, the price drops. You buy a new phone, and the next day, it's suddenly $200 cheaper. You book a flight, and a week later, there's a sale. That sting is familiar. Most people laugh it off. But now imagine that exact feeling, stretched out over months, maybe years, and instead of a phone or a plane ticket, it's your entire investment portfolio. You didn't gamble. You didn't chase hype. You did the reading, you listened to smart people, you understood the thesis, and you bought Bitcoin because, logically, it made sense. Scarcity made sense. Adoption made sense. Institutions stepping in made sense. And yet, here you are, watching the price move sideways, sometimes down, sometimes up, never quite doing what it feels like it should be doing. That's the moment where doubt quietly creeps in. Not panic, not fear, just that uncomfortable question looping in your head. Did I miss something? Because when the logic is sound, but the outcome feels wrong, your brain starts searching for explanations. And the dangerous part isn't the price itself. The dangerous part is what that confusion does to your decision-making over time. If you step back and look at the situation objectively, it becomes even more unsettling. On paper, this should be one of the strongest moments Bitcoin has ever had. The largest asset managers in the world are involved. Exchange-traded funds exist. Institutional custody is no longer some abstract future concept. Retirement funds, endowments, and conservative capital that once laughed at this asset are now at least paying attention. By every traditional measure of legitimacy, Bitcoin has crossed the threshold. And yet, instead of exploding higher, it stalls. It hesitates. It pulls back. It trades in a range that feels disconnected from the narrative everyone has been repeating for years. This is where frustration turns into mental noise. People start refreshing charts, scrolling social media, watching price predictions they don't even fully believe, just hoping someone else can explain what they're seeing. Because when reality doesn't match the story you were told, the instinct is to assume the story was wrong. But sometimes the story isn't wrong at all. Sometimes the mistake is assuming price moves in a straight line toward truth. Markets don't reward being right. They reward surviving long enough to stay in the game. And when an asset refuses to behave the way logic says it should, that's usually a signal that something else is influencing the outcome. Something structural, something psychological, something most people aren't even looking at yet. This is the point where most investors give up too early, not because they were wrong, but because they didn't understand the pressure being applied behind the scenes. I'll be honest, when I first started pulling on this thread, I didn't want to believe where it led. The idea that price could be held back even when adoption is real sounded uncomfortably close to the kind of explanations people use when they don't want to admit they were wrong. I've always been skeptical of that. Markets, in my mind, were chaotic, sometimes unfair, but ultimately honest in the long run. If something had real value, price would eventually reflect it. That belief is comforting because it means patience is all you need. But the more time I spent looking at how modern financial markets actually work, not how we wish they worked, the more that belief started to crack. Not because of some secret meeting or illegal scheme, but because of incentives, structures, and pressure points that exist entirely in the open. What made this hard to accept wasn't fear, it was discomfort. Because if prices can be influenced without anyone breaking the law, then being right about an asset isn't enough. You also have to understand the environment it's operating in. And once you see that, once you really see it, you can't unsee it. That's when I realized this wasn't about Bitcoin at all. Bitcoin just happens to be where this pressure is becoming visible. To understand what that pressure looks like, you have to start with a situation that seems completely unrelated at first. Imagine a country trying to grow faster than its own economy will allow. Infrastructure needs funding. Public projects need capital, and progress feels urgent. So it borrows, not in its own currency, but in a stronger one it doesn't control. At first, everything looks fine. Payments are manageable, growth appears real, and optimism fills the gap between reality and risk. Then the environment changes. Interest rates rise. The stronger currency becomes even stronger. Suddenly, the debt doesn't just grow, it tightens. Payments consume more resources. Options disappear. The country isn't failing because it made reckless choices. It's failing because it entered a structure where time and control no longer belong to it. This is the essence of a debt spiral. Not a dramatic collapse, but a slow narrowing of choices until every decision becomes defensive. The real damage isn't financial at first, it's psychological. When you owe in something you can't create, you don't just lose flexibility, you lose leverage. You start selling what you didn't want to sell. You agree to terms you would have rejected under calmer conditions. And here's the part most people miss. None of this requires bad actors. No one has to cheat. No one has to conspire. The structure does the work on its own. Pressure builds naturally, predictably, and legally. Once you understand this dynamic, you start noticing it everywhere. Because it doesn't only apply to nations. It applies to companies, and in a quieter way, it applies to individuals too. Think about how this plays out on a personal level, because this is where it becomes uncomfortable in a very familiar way. Imagine owning a house you genuinely love, something you plan to keep for decades. You take on a line of credit because rates are low and it feels manageable. At first, the payments barely register. Life goes on. Then conditions shift. Rates climb. Monthly obligations quietly double. Nothing about your income changed. Nothing about the house changed, but your margin for error vanished. That's when psychology takes over. You stop asking what the best long-term decision is and start asking how to survive the next few months. You consider selling earlier than you planned. You consider refinancing into worse terms just to buy time. Every choice feels rushed, and every rushed choice benefits the party on the other side of the contract. The pressure doesn't scream, it whispers. And that's why it's so effective. Because by the time you realize you're trapped, you're already reacting instead of deciding. This is what financial pressure looks like in the real world. It doesn't announce itself as danger. It disguises itself as responsibility. And when you scale this exact dynamic up, when you replace a house with tens of billions of dollars in assets and replace a homeowner with a publicly traded company, the emotional mechanics don't change at all. They just become harder to see from the outside. At some point, the label stops matching the reality underneath it. On paper, MicroStrategy is still described as a software company, a business intelligence firm that sells analytics tools to enterprises. But functionally, that description no longer explains how the company behaves or why its stock moves the way it does. What it has become is something far more unusual, a publicly traded entity whose core strategy is to convert capital into Bitcoin as aggressively as possible. Shares are issued. Debt is raised, preferred stock is sold, and nearly all of that capital flows in one direction, Bitcoin. This structure is bold, even elegant in a way, because it turns traditional corporate finance into a leveraged bet on a single scarce asset. As long as conditions are friendly, it works. The stock trades at a premium, confidence feeds on itself, and access to capital stays open. But embedded inside this strategy is a quiet vulnerability. Debt comes with obligations. Preferred shares come with mandatory payouts. Those payments don't care about market narratives or long-term belief. They arrive on schedule. And when your core asset is volatile, time becomes an enemy. The business no longer revolves around selling software. It revolves around managing pressure. Cash reserves matter more than revenue growth. Stock price matters more than fundamentals. At that point, the company isn't being valued for what it produces, but for how long it can hold its position. And once a company reaches that state, the market stops treating it like a business and starts treating it like a stress test. When things are working, the structure feels almost self-reinforcing. Confidence pushes the stock higher, the stock trades above the value of the underlying assets, and that premium becomes fuel. New shares can be issued without pain, capital flows in, more Bitcoin is acquired, the asset rises, and the cycle feeds itself again. From the outside, it looks like momentum. From the inside, it feels like control. But flywheels only work as long as nothing interrupts them. The moment sentiment shifts, even slightly, the mechanism reverses. A falling stock price isn't just a signal, it's a constraint. Issuing new shares suddenly becomes dilutive. Raising capital stops making sense. And once that happens, the safety net disappears. Cash reserves start to matter in a way they never did before. Every quarter becomes a countdown. If obligations still need to be met and capital markets close their doors, the only remaining option is to sell the asset the entire structure is built on. This is where the trap tightens. Selling Bitcoin to service debt pushes the price down. A lower Bitcoin price puts more pressure on the stock. A weaker stock eliminates the option to raise capital. The loop feeds on itself, not because anyone wants it to, but because the structure leaves no alternative. This is what people mean when they talk about a death spiral. Not a sudden collapse, but a gradual erosion of choice. And once a company reaches this stage, it doesn't need an external enemy. The system applies pressure automatically. At this point, the uncomfortable question naturally follows. If pressure like this can exist without anyone breaking the rules, who actually benefits from it? The answer isn't as dramatic as people like to imagine. Large institutions don't need chaos, and they don't need collapse. What they need is access. Pension funds, endowments, and conservative pools of capital move slowly, and they are restricted in what they can buy and when they can buy it. Volatility is a problem for them, not an opportunity, unless that volatility creates forced sellers. Distress is where leverage quietly changes hands. When a company is under pressure, it doesn't sell assets the way retail investors do, clicking buttons in panic. It negotiates. It arranges block trades. It accepts discounts in exchange for certainty. And those discounts don't exist in calm markets. They only appear when time is working against someone. This is why pressure doesn't need to be malicious to be profitable. Incentives do the work. If an institution believes a long-term asset has value, but also believes it can be acquired cheaper through patience and pressure, waiting becomes the rational strategy. No conspiracy is required when the math already points in the same direction. History has a way of repeating itself. Not loudly, but in patterns that only look obvious in hindsight. Decades ago, similar pressure played out in other markets, with other assets, under different names. Companies entered financing structures that seemed survivable, even clever, until market conditions shifted and time turned against them. Share prices fell, confidence cracked, and suddenly capital that once felt abundant vanished. What followed wasn't fraud or scandal. It was something quieter. Assets changed hands at discounts. Early believers exited in frustration. Patient capital stepped in, accumulated, and waited. The people who lost weren't wrong about the value of what they owned. They were simply forced to act before the value had time to surface. That's the part history rarely emphasizes. We remember outcomes, not the pressure that produced them. And when you look at those stories closely, a familiar rhythm appears. Optimism, leverage, tightening conditions, and finally, a transfer from those who needed certainty to those who could afford patience. Once you see that rhythm, it becomes hard not to notice how often it shows up again, especially in markets where volatility is already accepted as normal. This is the point where the story stops being abstract and starts pointing directly back at the individual sitting on the other side of the screen. Because when you strip away the institutions, the structures, and the historical parallels, what's really being tested is behavior. Retail investors experience volatility as loss. A drop in price feels personal, almost accusatory, as if the market is telling you that you were foolish to believe in the first place. Institutions experience volatility as information. They ask why it's happening, who's under pressure, and how much time that pressure can last. That difference in perspective is where outcomes diverge. When uncertainty rises, retail investors look for relief. They want the discomfort to stop. Institutions look for asymmetry. They want situations where someone else's need to act creates an advantage. This is how wealth transfers occur without deception, without fraud, and without anyone technically doing anything wrong. Pressure does the convincing, fear does the timing, and patience collects the reward. The hardest part is that none of this feels dramatic while it's happening. It just feels exhausting. Charts fluctuate, headlines contradict each other, and eventually people convince themselves that stepping away is the responsible choice. That moment, the moment where you trade long-term conviction for short-term emotional relief, is where the game quietly ends for most participants. The real payoff of understanding all of this has very little to do with predicting where price goes next. It has to do with changing how you interpret what you're seeing. Once you recognize that markets are shaped by pressure, incentives, and time constraints, short-term volatility stops feeling like a verdict on your intelligence. It becomes a signal, not about value, but about stress. And stress always reveals who has options and who doesn't. This is where professional investors separate themselves from everyone else. They don't assume price equals truth in the moment. They ask whether the underlying thesis is intact and whether the current movement reflects fundamentals or mechanics. When the pressure is mechanical, when it comes from structure rather than substance, the response flips. What feels like danger to one group looks like opportunity to another. That's not because professionals are braver. It's because they're playing a different game. They're not trying to feel good today. They're trying to position themselves for when the pressure releases. And pressure always releases eventually, either because the structure adapts or because the environment changes. Understanding this doesn't guarantee profit. It guarantees clarity. And clarity is what allows you to act deliberately instead of react emotionally, which is the single biggest edge most people never develop. What actually matters going forward isn't guessing whether Bitcoin will be higher or lower next month or next quarter. It's recognizing what kind of environment you're operating in and adjusting your expectations accordingly. Volatility doesn't mean something is broken. In many cases, it means something is being tested. Cash positions, debt structures, patience, and time horizons all start to matter more than conviction alone. If you believe in the long-term thesis, then the most important question isn't why is the price down? It's who is being forced to make decisions they don't want to make right now. Because forced decisions are where leverage changes hands. Watching how pressure builds, how balance sheets evolve, and how narratives shift tells you far more than any short-term chart pattern ever could. This is where understanding market mechanics becomes a form of protection. Not protection from losses, but protection from panic. And panic is the one thing markets reliably punish. When you understand the rules of the game, you stop confusing noise for meaning. You stop outsourcing your confidence to headlines. And you realize that most people don't lose because they were wrong. They lose because they didn't give themselves enough time to be right. The reason I've taken the time to walk through all of this isn't to convince you that Bitcoin is guaranteed to succeed, or that institutions are always right, or that pressure magically turns into profit. It's to make one thing clear. Markets don't transfer wealth by accident. They do it through structure, through timing, and through psychology. When an asset is volatile, when the narrative feels conflicted, and when emotions run high, that's not a sign the game is broken. That's a sign the game is active. People who don't understand the mechanics interpret that tension as danger. People who do understand it see a test of endurance. And endurance, more than intelligence, is what markets ultimately reward. You don't have to predict the future to navigate this environment. You just have to know what you own, why you own it, and how pressure can distort behavior before fundamentals have a chance to assert themselves. The most expensive mistakes aren't made because someone was uninformed. They're made because someone was uncomfortable for too long. If you believe a scarce, decentralized digital asset has value in a world where financial systems are increasingly strained, then short-term pressure shouldn't scare you. It should prompt better questions. And if you don't believe that thesis, then no amount of reassurance will ever make this volatility tolerable. That's the real dividing line. Not price, not timing, but understanding. Because once you understand the rules, the noise loses its power. And when the noise loses its power, you stop playing defense and start thinking like the people who never needed certainty in the first place.